Buying a home can leave you broke in a blink of an eye. In addition to ridiculously high income prices, homeowners are also saddled with other expenses associated with owning a home. Hello and welcome back to the Finance Guardian channel. Now in this video, we'll share tips on how to buy a house without going broke. So hit that subscribe button and the bell beside it and let's get started. You see, even though buying a home is among the most rewarding ventures you will ever undertake, you must also understand its risks. Being equipped with enough knowledge will make the process easier for you and help you avoid common pitfalls. For example, overbuying is one of the risks that are associated with purchasing a home. It refers to situations where the asking price for a house is more than it should be, or where a potential buyer settles for a home they cannot afford. A new buyer may have difficulty spotting an overpriced home, making them a potential victim of overspending. Unfortunately, this is not an easy pitfall to escape. If you exceed your budget when buying a home, you will be sabotaging your finances for decades. So how can you avoid all these risks of going broke? It's simple. Be on the lookout for the telltale signs and common pitfalls. The first way is to avoid houses that are priced beyond their actual value. Comparing the price of a house with those in the same neighborhood can show that it is overpriced. The second is to assess your situation. An excellent way to figure out how much you can afford without going bankrupt is to examine your income closely. Take into account whether you will continue to be employed full-time or part-time in the near future. Does your income include other sources of income, such as a side gig or rental property? Have you been receiving child support or alimony? Your financial situation will be influenced by all of these factors. Similarly, you should look at your expenses, making a list of your bills and other debts or payments you owe so you understand how much of your budget is already taken. Ensure that you also budget for your daily living expenses such as groceries and gas to make sure you can meet your monthly obligations. You should keep in mind that the amount you think you can afford and the amount a mortgage lender is willing to lend you for a home purchase might not match. This is because your lender looks at how much debt you pay each month in relation to your income. You may think you can afford a certain amount, but a lender looks at certain formulas like your debt-to-income ratio, your employment, and your credit history, says Sherry Ludecker, a top-selling real estate agent in Johnson City, Tennessee, who specializes in helping first-time homebuyers. All those things affect the amount of money that a lender will give to a buyer. You should really be talking to a mortgage lender before you're looking at houses to make sure you are in the right ballpark. In 2019, the typical buyer financed 88% of their home price and put down 12% of the purchase price as a down payment. You'll need to look at how much money you have saved and how much you plan to put down on the down payment and closing costs because both have a bearing on your overall ability to afford a home. Third is to hire a dependable real estate agent. Realtors can sometimes persuade you to purchase an expensive home so they can earn higher commissions. Set the record straight about your budget at the beginning of the home buying process and stand your ground if they try to convince you otherwise. If your agent persists, you can always hire another one. Next is to explore your options. Start by talking with a mortgage lender or your bank before making assumptions about what you'll qualify for and what you can afford. If you don't have a great lender in mind, your real estate agent can give you some trustworthy options. Once you connect with a good lender, find out your loan options. Some loans like FHA loans, USDA loans, or VA loans allow you to purchase a home with a low down payment. 3.5% down for FHA and 0% down for USDA or VA, but with a few caveats. Discover your loan options once you've connected with a good lender. Some loans, such as FHA loans, USDA loans, or VA loans, permit you to buy a house with a low down payment, 3.5% for FHA and 0% for USDA or VA, but with some restrictions. In the case of FHA loans, borrowers who put down less than 20% are required to pay mortgage insurance. If you put down less than 10%, an FHA loan can direct you to pay mortgage insurance for as long as you own the house. Decide what type of interest rate you will receive. Your interest rate may be higher if your credit score is low. Which credit scores are considered low? According to Bank of America, a credit score of 670 or higher is generally regarded as good. If your credit score is below 620, you may have difficulty getting a mortgage. If that's the case, you may want to ask your lender if it will be worth waiting a few months while you work to improve your credit score to get a better interest rate. Don't forget to consider the fact that a 15-year or 20-year mortgage will come with a lower interest rate than a conventional 30-year mortgage. As a hypothetical example, a $300,000 30-year loan might have a 4% interest rate, while a 15-year loan for the same amount might have a 3.25% interest rate. After seeing what's possible, it is to evaluate housing. Find out how much a home costs in the area where you're interested in buying. In addition to paying mortgage interest and property taxes, you'll also have to pay homeowners insurance. There will also be a mortgage insurance if you're putting down less than 20%. If the neighborhood you're interested in has a homeowners association, as more than 40 million Americans do, You should know that monthly HOA fees can be as high as a few $100s. You should also remember that if you're looking at a home with an HOA, lenders will consider the HOA fees when assessing how much you can borrow. Think about how much you are planning to put down on your home. Get with your licensed agent who can speak to additional expenses you might expect in your area. There are various one-time costs involved with buying and insuring a home and ongoing expenses. A buyer should definitely budget for a home inspection and any other inspections that aren't being paid for by the seller. Those might include termite inspections, septic inspections, or HVAC inspections. Then be cautious when making comparisons. Do not ruin yourself with an expensive home simply because your friend Molly has a sprawling bungalow. Prospective home buyers find themselves compromising their budgets due to public perceptions. Their home ownership process is influenced by external forces, yet they are the ones who will pay for it. Don't become a part of the statistics. Once you've planned your home ownership budget, stick to it, regardless of how lofty other people's homes may appear. Start thinking about ways to make your home better instead of comparing it to what others have without putting a strain on your finances, of course. Finally, avoid making the mistake of overbuying a home when you think your career prospects are bright. It is nice to have ambition, but you shouldn't gamble with your home, which shelters you and your entire family. Regardless of how lucky our lives are, we all have experienced bad luck from time to time, so always leave wiggle room for rainy financial days. Don't overlook life changes that may have a big impact on your budget. For example, if you want to start a family, you'll need to adjust your budget upward. If you have children in the future, make sure that you buy a home that you can afford once they arrive. As such, do not accept the first mortgage offer you receive. Most potential home buyers are misled by this loophole into overpaying for a house. Just because a mortgage company pre-approves you for a certain amount doesn't mean you should buy up to that amount. There is no difference in whether you expect a raise or promotion. Focus on what you can afford now. Remember, while lenders are in the business of making money, the borrower's goal, which is you, is to maximize every opportunity to save money. And that's all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new around here, subscribe to our channel to remain updated about all of our future videos. We'll see you next time.